And welcome to this yet another episode. And in today's episode, basically, I want to focus on why indicators confuse new traders and what to focus on instead as a new trader. So, if you ever thought that indicators worked the way you think or the way you perceive them to work, then traders wouldn't need experience in trading. There will be maybe probably what we call or what I can call a magic indicator that everyone will use it and nobody will lose money. So that alone should make you ask question how indicators are actually meant to be used. And this is what you're going to demystify in this particular video today. So what you need to understand is that indicators don't predict price, they describe the past price. And the reason why I've always said indicators are lagging span. So the price has to move so that the indicators can imitate what the price has already done. So, and the moment you stop experiencing or the moment you stop expecting them to be predictive and start using them as supportive tools, your trading clarity changes dramatically, right? So, you realize that most traders misuse indicators, not because they are unintelligent, but because they misunderstand what indicators are designed to do. So this message is for traders who feel overwhelmed by charts, who stack indicators, hoping one will confirm another, and who keep switching settings, strategies, or tools after every loss. So let me begin by let me first of all share and say that when you're using indicators, it is always significant to consider different indicators, yes, so that you can have a multiple confirmation because you're looking for a confluence. But again, the disclaimer is this, that if you stack so many indicators in your chart, like you can see this chart, we have a lot of indicators such that it becomes even very difficult for you to perceive where the price is. There is the Ichimoku, there is the moving average 100, the moving average 200, there is the parabolic SAL, there is the RSI, there is the MACD. So it becomes really difficult for you to be able to really follow the price. See, the more you add them, maybe even you can add the stochastic oscillator. So the more you add them, the more the charts becomes clumsy. So you can see that kind of a chart, it really looks clumsy. So and the reason why today I want us to clear up one misconception. And you need to understand that price moves fast and indicators react. Okay, so price moves fast and indicators react. So indicators are basically lagging span. So if your decision making is driven by something that reacts to movement, then by the time you enter, the market has already shifted. Okay, so you believe you're now getting the gist. So the first part that I want us to understand is lagging versus leading information. So, like I said, indicators are lagging by design. Moving averages, RSI, MACD, stochastic, they are all built on historic data, right? So they calculate where price has been, the average price, the average previous candle, the rate of change in previous movement, momentum based on completed data. So when beginners think indicators are giving them a signal of what's coming, they are actually looking at what already happened. So this is why indicators often give or that is the reason why indicators often give signals after the move started, confirm too late, and trap traders at the worst moment. So because you're entering when the signal appears, but institutions entered long before that. Okay, so that's the lagging bit of indicators. Now, leading information is different. And the leading information, we are talking about liquidity, we are talking about structure, we are talking about session timing, we are talking about institutional behavior. And this gives context, right? So leading information gives context. But now when you're using indicators, they give description, right? So because when you look at even these particular charts, first of all, there are so many indicators. Let us even delete do away with some indicators here. We see what Even we can do away with the parabolic SAL as well. We are left with that, and then we do away with the MACD, and then we look at this particular piece of price action. Okay, so look at it this way. When even the fact that the price was at this particular point, okay, so the price was at this particular level, okay, so by the time these indicators are confirming, all right, by the time these indicators are confirming, because if you're using pure price action, here is an entry. Okay, here is an entry because we have a BOS here, the price dropped, then the price comes back again to this level. So there's an order block, and then now you take a trade. So that's how institutions trade. Okay, that's how institutional trade. They are looking at the liquidities, targeting probably the liquidities at this particular point. Okay, so but now for you, before the indicators confirm, or before the indicators are able to confirm to you that it's an entry, because if you look at like maybe probably something like the stochastic, it's already above the in the oversold area. So before that confirmation happens, the stochastic to be on in the overbought area, and then now we have the two trend lines in the stochastic crossing down and pointing, crossing over and pointing downwards. The price will have already gone. Okay, because indicators are lagging. But for someone who uses structure, for someone who uses liquidity, for someone who uses session timing, institutional behavior trading, they could have gotten that kind of a trade early enough. Okay, so part two, I want us to understand why sticking indicators reduces clarity. Okay, so and I've said one indicator confuses you, then you add another one, and then you add another one, you add another one, so the chart is very dirty. Okay, so like probably now maybe we don't have any much clarity with these ones. You feel that there is not much clarity, so what you do is that you come and add probably another indicator. So it can be probably parabolic SAL, so you add it there. So you can see the more you are stacking them, the more even it's really confusing you, because you cannot be able to follow the price. Okay, so now your charts, once you stack all these indicators, let's even add another one like the Ichimoku Kinkoyo, right? So you can see, so as you stack those indicators, now your charts looks very dirty. You can see a lot of greens, you can see a lot of dotted figures or dotted lines, such kind of things, oscillators crossing, buy sell arrows, clouds, dots, histogram, whatever, call them, those indicators that you stack there. Okay, and there are even those others that are custom made that you have to buy them and install them in your MetaTrader 5. Okay, and suddenly once you do that, what happens is that you're not trading price anymore, you're trading your indicators. And here is the psychological trap with these indicators. You think that more tools means more certainty. Okay, but more tools create more conflict. Okay, more tools create more conflict. And for instance, you might have all those, the AMAs maybe probably are saying buy, the RSI is saying sell, the MACD says maybe probably you wait, the stochastic says it's a reversal, the trend line says it's a breakout. You can even use the Fibonacci, which says retrace, and now you are confused what next. Okay, so there is no clarity, you are paralyzed in your trading. So when you rely on tools, you don't understand, you are not analyzing, but basically what you're doing is that you are guessing. Okay, and trading based on guesswork is purely gambling. Okay, and this is why, because stacking indicators decreases clarity while increasing confidence in bad decision. Okay, stacking indicators will definitely decrease your clarity while increasing confidence in bad decisions. So what you need to do is you need to have like maybe two indicators, one an oscillator, and maybe probably the other one a trend indicator. Okay, so and you are able to basically understand them, how they move, And a caution here is that these indicators, if you use them on the lower time frames, they'll always keep giving you signals after maybe a few minutes. Some will be very false signals. So I would prefer using them maybe probably on the higher time frame. Okay, and this is a supportive tool, not really per se as a signal tool. Okay, so that's what you really need to understand. Like probably if you're using the 200 moving average. Okay, so let me probably delete these other ones here, and we have um, can delete even these stochastic oscillator. All right, so we can have maybe those two. So what we can look at here now, see, this is what I was saying about. So when you're using the moving average crossover, this one has to cross over so that it can confirm it's a buy. But you can see already the price has really given us some good nice pushes here before even as we are waiting for the crossover to happen. All right, but now how will you use this? Someone who was using pure price action could have taken this trade very smart. All right, but now what I'm trying to say is this. The best way to use these indicators, use them from the 4-hour time frame, or even the least time frame you can use maybe is 1-hour time frame. And probably if you're relying maybe on the trend, if you don't know lower lows and lower highs, maybe you can look at instances when the price crosses below the 200 moving average. This means you're in a downtrend. Okay, and as long as the price is below 200 moving average 200, that means we are looking at a downtrend. The moment it crosses above, that means you are looking at an uptrend. So that is how you use indicators as a confirming tool and not as a signal. All right. So the part 3 that I want us to really look at it is now. What I've just begun explaining, what to watch instead. So if indicators are reactions, what should you focus on? Because that is the next big question. So there are 3 things that you should really focus on. Number 1, structure. How is price moving? Why is the trend? Higher highs, higher lows, breaker blocks, liquidity sweeps, order blocks. Okay, why? Because you realize that structure reveals intent. Okay, structure reveals intent. Number 2, the second thing to focus on is liquidity. So because you have to identify where the liquidities are, where are the stops, where will price likely search, what pool exists above or below. Okay, liquidity always reveals the targets. All right, liquidity always reveals the target, and if you're not able to identify liquidity, therefore it means you are likely to be the liquidity in the market. Number 3 thing to look at is the time. What session are you in? What time in the session? Okay, so maybe probably in London session, but what time exactly in the London session? Because if you're trading something like ICT the way I do, there is time and price theory, okay, that is taught by Michael, the kill zones that Michael really teaches, Michael Henderson, the author of ICT. So he talks about not just the session itself, but within London session, there is maybe probably the London kill zone, a specified duration of time that you need to really focus on looking at entering high probability trades. So you really need to understand, is it accumulation or like expansion? Is the price accumulating or do we have some expansion, right? So what we really need to understand is that indicators cannot tell you when liquidity enters, why price is moving, where the next sweep is likely. Okay, but price tells you all that. All right. So I'll be honest with you that when I began trading, I really hid behind indicators because I didn't trust myself per se. And indicators really made me feel like I was being objective, but in reality, I was just outsourcing responsibility. So I didn't want really much to think. I wanted to follow. I looked at different indicators, strategy that has ever been taught, a lot of them via YouTube. I spent my time learning them, trying to understand them, because I knew if these really indicators can be able to give me money, why should I learn? Why should I really focus more on like analysis and such kind of stuff? A lot of work doing pure price action. Okay, but it didn't really work as I expected. Okay, so I transitioned now. I started slowly transitioning from using indicators to now pure price action. So for those who have interacted with my charts, I don't have any indicator in my chart. I only use pure price action. Okay, so because I've learned with pure price action, simplicity helps me improve on my execution. Okay, so and what I want to put across is that indicators aren't evil. Indicators aren't bad. They are not useless. They are not the problem. The problem is expecting them to predict, to lead, and to replace experience. And that's the biggest mistake that new traders or the newbies really make in their trading. So instead, use them as a companion, not as a crutch. Okay, use indicators as a companion, supportive tools, but not as a crutch. Okay, so because price is always the truth, or price will always tell the truth, indicators are basically commentarily. Okay, so understand the difference, and everything else will start now shifting. All right, so in the next video I will show you what a good trade actually looks like, even when it's a losing trade. Okay, because the key thing is that even if you have those losing trades, as long as it was a setup, as long as it was a really a good setup, then that's still remains a good setup, irrespective of whether you made losses or you made profits. Okay, because a good trade isn't defined by outcome; it's defined by reasoning, risk, execution, right? So see you in that next video.